Welcome, everyone, to another week of the None of Our Businesses YouTube show and podcast. With me this week is Mark Pallardy.
Hey.
Jack DiMatteo. AJ Wheeler.
How's it going, y'all?
And Charlie Zigmund.
Hi, everybody.
And we're going to be talking about some current events in business, taxes, news, PPP, all of the above, as always, from an accountant's perspective. Here's a rundown of some of the things that we've got for you today. We're going to be talking about, are less experienced CFOs actually a better ROI for business? The business in MLB, an accounting automation startup raises $42.4 million. Doing tech and accounting. We've seen this story before. What's new? It's out of France. Managing cash flow for your business. Some key tips. And when is it too late? And then discussing the outgoing FCC chairman and his comments on when upload speed is fast enough. Our gamers on the panel have some pretty harsh opinions on this. And finally, the SBA 7A loan program, is it something that you might consider? Well, let's get to it. We'll start off with Charlie.
All right. So I've got an article we can talk about today from Forbes. It's called The Surprising Data Behind Why CEOs with Less Experience Outperform Those with More. And so what the article looks at is a study done in Harvard Business Review of 855 top executives in S&P 500 companies. And it looks at executives who had left from one position from a similar high-level position at another company and moved on to a newer company. And then it looks basically at their depth of experience. And it tries to make correlations about how well the companies are doing in terms of their share prices and in terms of revenue growth based on how well or how experienced the new CEO is. And so what the article found is that in companies that had a newer CEO with less experience, they actually outperformed the common metrics that are used to analyze how well the companies are doing, like revenue growth and profitability. And it talks a little bit about why it thinks this happens. It mentions that it thinks that CEOs who have been around in another organization are maybe more likely to stick to their old tried and true processes and aren't as open to change. And that newer CEOs maybe are more open to different alternatives and willing to implement new technologies and that sort of thing. And then the article brings up as an aside the idea that, well, maybe companies that bring in more experienced CEOs do that because they're often in a precarious spot and they need somebody to come in and kind of save the show, so to speak. And it brings it up as kind of like an afterthought. But I guess I'm kind of trying to view it with a grain of salt and think about, is this, correlation versus causation issue here? Are we really just noticing that companies that are in a difficult space bring in experienced people and, by the way, also happen to have a rougher time? And so I guess I want to get your guys' take on whether or not you can even perform this type of high-level analysis with this data that they've laid out, or is this just a confusion of correlation versus causation? What do you guys think?
I'll tell you, something that actually makes their case is probably the best example I've ever seen. I can't remember the gentleman's name, but he had been with Apple during their growth years with the Apple stores, and he moved on to JCPenney, and he absolutely thought, a CEO, you're probably dealing with somebody with a pretty big ego in a lot of cases, not all, but a lot. And, he took his ideas, which, you were selling Apple products at the time, which any one of us, the Pet Rock could sell Apple products at that time. He went over to JCPenney's and he had all the answers, and he got rid of their discounting and the way they did sales, and an already struggling retailer. I don't think the guy even lasted a year with the ideas. So, I would almost look at it. I look at it from the context of sometimes it's easier to learn things from scratch than to unlearn bad habits. Being in the military, I'd never fired a weapon before, and the drill sergeants, their take on that was great. We don't have to unlearn your bad habits, because you had people that had probably been using Kentucky windage and all kinds of bad habits that they'd learned since they were kids, and you had to unlearn the bad habits. So I mean, I don't think this isn't an every time, and I don't like to say every or always, but I can see certain circumstances where the experience might work to your detriment. I mean, you hear it all the time. Sometimes novice investors, they'll beat the S&P 500 all day long because I guess they're too stupid to know any better. Maybe, I don't know, but sometimes not having a preconceived notion, or living on your laurels and applying it to your next position. Sometimes it's a benefit not to be stuck in that same way of thinking.
Yeah, I think I'm gonna fall a little more on Charlie's side on this one, simply because it does feel like a fallacy that correlation is not causation. Because you can take any. I think Jack brings up some great points, but I think you can parse data in 100 different ways or more, and basically, if we look at 855 companies and we're determining that these ones are good and these ones are bad, and who are the young people working? Are they in tech firms, which the industry as a whole was going up anyway in this period of time? So therefore, they get the coattails of that. I mean, just like Jack's Apple example. And are the old, staid, experienced ones, at companies that are a little more commodities now? So they're not seeing this monumentous growth, so they're not considered as successful. I mean, what is a measure of success? Are your shareholders happy? Are you paying dividends? So there's so many different ways to slice this data. I think it's potentially a little bit dangerous if Harvard puts out a position that your younger CEOs are better, and it starts a trend that, well, let's get rid of all the old guys and just get new guys in here because that's going to bring us greater profits. So that was one of the I'm wondering what this guy is really driving at.
Yeah, it did seem like there was a little bit of an agenda baked into there. And I just wondered if, had the numbers gone the other way, would an article have even been written had that been the case? I don't know. But yeah, do you have another article we can talk about, Jack?
Sure do. This one comes from our friends over at ESPN, and it's kind of interesting because I read through it about 3 times trying to find the why, which they really didn't explain. But I kind of like the backdrop of the content, which was basically talking about Major League Baseball and scaling back the number of farm teams. Now, I knew this year with COVID, a lot of these smaller farm teams didn't even play a season. And, just based on that, a lot of them didn't have the financial wherewithal to survive to come back another season. So, the article kind of implies that Major League Baseball has had this plan in place to scale back on farm teams. But, I think back to when I used to hear, a lot of times the major league franchises, they make their money on the appreciation over the years, not so much, they spend a lot of money on players. The operation of it might not make a whole lot of profit, but the value of the franchise goes up increasingly over the years. I've always heard it said where, you'd be better off in a decent major size minor league city if you really wanted to make money on the operation of a ball club, because the parent club would pick up most of those big salaries, and you'd be really left with operating the fan club, the ticket sales, the concessions, those types of things. But I look at this article and it's really putting a crimp on a lot of small town America. And we've had this come up probably in the last month as we talk about this mini war on Main Street. And this kind of, now these aren't, a lot of these probably aren't career jobs, but a lot of them could be, it's a nice summertime boon for a lot of different businesses. You've got restaurants around the ballpark, ice cream stands. You've got, kids getting summer jobs inside these ballparks. And, to me, it's just a little bit of a disturbing trend to see a lot of these small towns get at least some summer jobs and some entertainment yanked out from under them. I think it makes them it's a little bit tougher, in an economy that's already strained. I hate to see this happen to some of these smaller towns. What do you guys think?
Well, actually, when I was reading the article, Jack, what it reminded me of was an article that we had talked about earlier on the podcast about the declining milk industry. This was way back when, probably a year ago. But I think if you take a look at like baseball's viewer numbers, if you look back at the turn of last century, at the beginning of the 1900s, the 3 major sports that were like the highest salaries, highest money rolls was baseball, boxing, and horse racing. And if you fast forward now to the 2000s, horse racing is nowhere to be found. Boxing has been outclipped by MMA vastly. And baseball, I think, is on the decline. I would challenge anybody sitting here to name me one major league catcher, You know, if you're not a baseball fan, I doubt you'd be able to name, or heck, even a good relief pitcher. You know, I mean, like for the life of me, I haven't watched baseball in probably 15 years. And so what I really see in this article is probably a business or a sporting business that's on the decline. And you see things like NASCAR, MMA, you know, those growth sports, soccer in America being a growth sport. And I think that there's only so much of that sporting pie to go around. And I think, well, and not to mention that during this pandemic, you've seen the boom of competitive gaming take over. So I think, you know, kids, you know, your target demographic for probably like sports fans of being that males 15 to 35, I think, you know, they probably know who Nick Merckx and Ninja is versus whoever the pitcher for the Yankees is. And I think you in those industries, you're really trading on brand, and you're trading on cultural awareness, I guess is the best way to say it. And baseball just doesn't have that right now. Baseball doesn't have a Conor McGregor or a Ninja or, you know, a LeBron James to bring people out to want to see the next LeBron James, the next Ninja, the next big thing. I think what you see is like, there's probably a lot of people that still love the game. There's probably a lot of small towns that enjoy that minor to major league baseball fun. But I just see, like, I guess salaries have held steady. So you're talking about, you know, if your revenue pie is shrinking, you still have the same kind of expenditures that you're talking about, and your brand doesn't trade on the same kind of height it used to. I just think we're seeing an industry in decline. And I think you're trying to see Major League Baseball try to manage that by cutting those farm teams, because I just don't think there's a need for it, you know, as much as there was come the turn of the century, last century.
Points well made, AJ. It's funny that you say that, because there was a time I could name just about every starting rotation on everybody's team in the league, and I'll bet you I couldn't name five starting pitchers in the entire league. So I can say, I don't know if that's just the product of my age or not, but you know, it's funny. I started taking my kids to stock car tracks, which back in the day, the grandstands would be packed. You know, now it's abysmal. You got three cars chasing this, you know, 3 heats with the same 3 cars chasing each other around the track. It's just, kids just don't go out and work on cars anymore. It's just not what it used to be. And great points. How about you, AJ? You got anything for us this?
Yeah, actually, this comes from TechCrunch, and there's a new accounting automation startup, George's, raised $42.4 million and rebrands to Indy. So this is an accounting software that I had never heard of. And so I did some interesting, well, we'll start. It's a French startup. So maybe that's why we haven't heard of it. We're based in America, so but our baguette friends over there in France have this Georges.tech. And I guess they were able to raise 35 million euros. And the company is getting a new name called Indy. And so I guess Singular and former Alvin Partners, there's this VC firm that has pumped some money into them. So I decided to take a look. And the article is basically a fluff piece about how great this Indy is. And essentially they go through all the same process that you can think of from QuickBooks to Xero of, you know, we'll automate your bank feed. And, you know, it's really aimed at solopreneurs or small businesses where you hook up your bank feed, Indy will learn what your expenses are and give you suggestions. Then you go in there and manage it. And guess what? Your accounting's done. And then you can hit the button and file taxes and know what your VAT is. So VAT is a value added tax for foreign countries. It's, you know, it's enabled in France and most of the European Union. And so I had a quick look at what Indy, I guess, ex-George's is what they call it. The website's all in French, but luckily Google Translate helped me out here because it's been about 20 years since I took a French class. But price is about what you would expect, 20 euros a month or 50 euros a month, depending on what level you would like it. So it's right in line, I think, with what a QuickBooks offering would have. But I guess my question is like, I guess QuickBooks doesn't have like a French equivalent. You know, I guess Xero probably is international since they're coming from New Zealand. But I'm wondering, you know, I guess, is this a flash in the pan? Because it sounds very, I guess, you know, fluffy, I guess, for lack of a better word, that it's kind of just QuickBooks in French, I guess, when I look at it, or QuickBooks Online in French, if I look at it. Or do you see this as maybe like a new kind of niche audience where you could have like a Romanian or an Italian QuickBooks that gets, a local market, I guess? Are we going to see our accounting programs, somebody fall in love with like a European or a UK version of QuickBooks that maybe offers more? So I don't know. I'd like to get your guys' take and see, what you guys think about it.
Well, I mean, I would say that definitely now that our baguette friends have turned off the podcast, we can just sort of say that I think it's all boils down to what level of integrations there are, because I think if you work with a lot of French banks, so like if you're a contractor in France and you just want simplicity, then QuickBooks is going to need to work for the banks that you use for that to really make sense or be a true competitor. And I think that's probably where I see this maybe having the most chance to kind of succeed, is by leveraging those less used banking partners that are maybe more regional. I haven't looked at the tool at all to know if it really does that. And so I don't know if that's what it is, but I think the idea of having a product geared at making things easier for independent contractors to do their accounting and handle like sales tax, I think there is a need there. I can't say whether or not I think they've met that need, but yeah, it seems like it could be a competitor.
Yeah, I have to say, I went into this article a little biased, probably because of TechCrunch, not because of George, but more likely because they say right there in the article, this is going to replace your accountant, or it could replace your accountant. And anybody who is out there who has worked with clients with QuickBooks, garbage in, garbage out. If the person on the other end who's classifying or is receiving information doesn't know what they're doing or doesn't know how to classify things, it doesn't make George or now Indy any more of a great platform. Even if you're eating a baguette and sipping wine, it might be better working with IFRS than QuickBooks would be. But, if you're platform agnostic, I still don't think the role of the accountant goes away unless you get super sophisticated AI that knows how to interact with a company and can make some of these high-end decisions. And I don't think we're there yet.
I think it becomes a challenge for these companies to be able to do this scalable. If you're going to like you'd mentioned, like every country is going to, form their own split off of this. And that's where, I'll go back to Concur for an example, supporting that. And what they'll do, you get the big enough company, they have the ability to do the development, and they have the resources, and they'll do the modifications so that, if you've got to modify the policy to work in Germany, France, wherever you're dealing with, you can make those slight modifications. I think it's going to be, is there a big enough scale for that company to be able to turn enough profit to be able to put that much into development and keep these products on the cutting edge to compete with some of the other with their competitors who have a global presence and will put money and can put more money into development? That's kind of where I see some of these is having a natural vulnerability to still compete with somebody on a global scale.
I think we've seen in our industry multiple times, and it's broader than our industry. Service companies posing as tech companies, service companies posing as software, and there's just and I think it goes back to what Mark said. It's like, well, until the AI technology is actually there, that's all it is, and it's interesting why these startups do that. But one of the reasons they kind of do that, which is you would think that the markets and the money available would be smarter than this. But one of the reasons that this has become a thing is because if you're wanting to start kind of this service type business and you kind of throw this tech element into it, and you kind of position it as if it's a tech company, that gives you access to the VC market. And so you can go out there and raise money for the business, where normally VC firms don't invest in professional service companies. So that's the thing, is that you make it look like it's scalable and that you've got the economics of a software company, but under the hood, it's really just people doing the work. And that's time and time again, that's what these companies find has to happen, is that they can't really solve all these problems with software and automation, that they have to basically revert to being a professional service company. But to their credit, they end up with a pile of cash to scale their professional service company, that those of us that just go at it as straight professional service companies don't have, because we didn't position ourselves as tech companies to go out and raise money like that.
Well, I'd just like to say this is a good time to make the announcement that TCA is now a tech company. So if there's any VCs listening, please send your investment funds over here.
Yes,
I'm kidding, right?
we'll be prepared to share our annual recurring revenue and with you and our SaaS platform for integrating with our clients.
Yes, it's true. SaaS is short for Slack, always on. No.
Yes, that's right. Yeah. Slack always available.
Yes. Mark, do you have another article for us?
You bet. So let's talk a little bit about Bitcoin and some cryptocurrency. There's an article from Business Insider that I found this week that says Janet Yellen, who is, by the way, the nominee for Treasury Secretary, suggests curtailing cryptocurrencies such as Bitcoin, saying they are mainly used for illegal financing. So as I dipped into this article a bit, first off, I don't really think a Treasury Secretary or nominee for Treasury Secretary should be saying we should cut off any currencies. There is a case to be made that cryptocurrency has been used for illegal purposes, and because it's not traceable or as easily traceable as other forms of currency, it is used for illegal purposes. But this article, which brushes over the good aspects of cryptocurrency, seems to suggest that that's all it's used for. And we know that that's not all it's used for. But on news of Janet Yellen kind of pushing against cryptocurrency, both Bitcoin and Ethereum at the time of the recording of this podcast were down 8 and 10% as a result of this, because they think a crackdown is coming. Now, on the other side, they do mention that cryptocurrencies can help prop up currencies in markets. Think maybe some sub-Saharan African country where there's danger of currency going insolvent. You can have cryptocurrency kind of serve as a secondary prop up of the market. So I think making these comments, and I don't know what her position will be and if she's going to get voted in. I think she's a very smart woman, but I think the government line that cryptocurrencies are only used for illegal purposes is kind of an old school way of thinking about this, because there are tons of people now investing in cryptocurrency and tons of people who are seeing their value go up, and having an alternative form of currency that maybe the government can't as easily tax is the real problem here. But I'm curious to hear what you guys think.
Well, I'm kind of surprised she didn't mention that we should do away with cash, because if you're talking about illegal payments for goods, I mean, cash has been used for hundreds of years to pay for illicit goods and transfer across borders, in suitcases and shipping containers. I mean, if you ever watched Cocaine Cowboys or anything, it wasn't so much like selling the cocaine or getting the money. It was what you did with all of it after that. You had to wash it, you had to get it somewhere. Cash stinks. So I think it's naive to think that if you just did away with Bitcoins, all of a sudden, the black market for everything would just go away. I mean, people are going to find a way to pay for these things one way or another. And I think it's probably a short-sighted view of, I think you're probably right. There's probably some underpinnings of some kind of reform there to be able to trace some of these transactions. But then I think you kind of nip blockchain in the bud by that, because blockchain is supposed to be encrypted 9 ways till Sunday so that it can't be intercepted or, stolen or whatever. And you have a complete register of where it went, as long as you have the password to be able to look at it. So I think crypto is the future, but how far off in the future that is, I think is anybody's guess. I think that's the $1 million question is, if crypto is going to replace dollar bills, when is that? I don't know, but I don't think getting rid of it solves any of these problems she's talking about. And I definitely don't agree that, all Bitcoin or, cryptocurrency use is for illicit means. So
Yeah, I gotta agree with both of you here. I think that she's kind of honed in on one side of the story here and not given enough thought to the other side, because I mean, we have, like Mark said, we have all sorts of bank fees and currency type manipulation, things that happen with different governments and whatnot. And so I think there are drawbacks to kind of every currency and every form of payment. We have all kinds of fraud on things like credit cards and checks, and the challenges for each avenue of payment are unique for that type of payment. And so I think having another option is always a good thing. And like anything else, it's going to continue evolving and becoming more and more widely accepted. And yeah, I'm with you guys. I think if we're looking at what currency has been used for more illegal activity, I think we've got to give it to cash over anything else, going long over a long enough time scale.
You know, I kind of interpreted the same way you guys did, where I pretty much, it sounds like a cop out. I was actually really kind of surprised by that, because as long as Bitcoin has been around, what I would have expected is to hear something more along the lines of, you know, we realize a lot of this is being used for illegal purposes, and you know, we're going to monitor it or regulate it, or, you know, that's kind of what governments do, right? That's their gig. They regulate things, they monitor things. So I kind of took the same thing that you guys did. It really sounded like a cop out. I would have expected to see something more along the lines of, we're going to increase regulation and scrutiny on it, but we're not going to try to even think about eliminating it.
Yeah, and one other funny thing I forgot to mention was that one of the arguments was, well, cryptocurrency is based on nothing. Well, I'm sorry, but we've gotten away from the gold standard a long ass time ago. There's not enough gold in Fort Knox to cover the money that's in the American system. It's pretty much cryptocurrency as it is anyway. And if Janet Yellen wants to remove it, in one way I'd be okay with it, because then maybe I could finally get my damn graphics card that I'm waiting on, that all you cryptocurrency miners are keeping away from me. So with that being said, rant over. Charlie, you're up.
All right, so I'll take it back down a notch here. I've got an article from Accounting Today called Managing Cash Flow, a Critical Factor to Small Business Success. And so it's one of these kind of generic articles that discusses challenges business have with cash flow. Of course, we're in the pandemic still, and so people are seeing, declining revenue, people paying their bills late, and that kind of a thing. And so it's just this constant challenge that's on everybody's mind. And so I thought we could kind of take a look at what some of the different questions that the author of the article thinks are the main questions to ask when you're working with a client who may be having issues with cash flow, and see whether or not we can think if there are maybe some other things, maybe these aren't good questions. And so, yeah. So what they're saying, that the things that we should be asking clients who have cash flow issues are, ask them if they're reviewing their monthly performance against their budget and what trends they're seeing. Ask them maybe the most direct question: do you feel like you're running out of cash? Which is, yeah, how can you beat that question when it comes to this issue? What credit options do you have in place, and have you scenario planned for a situation where you would need a line of credit? What are the company's baseline operating costs? Do you have any savings for the business? And do you have a plan regarding the maximum amount of personal capital you're willing to invest in the business? And so, yeah, like I said, I think these are some of the most major questions, but I'm curious if this is your same approach when you're discussing cash flow with clients.
I think
You can kind of see the blank stares coming from a lot of business owners as you ask those questions.
I think the problem, I mean, this scenario gives me heartburn because of the paradox that we get in with clients, or that any account gets in with clients. It's like at that moment that they need you most, and that we need to work on these cash flow issues, that's also the moment they can't pay you, right? So it's like, it's really like, and that's the thing, is that when you get into it, it's actually very expensive to be in a cash flow crunch, right? Because when your company or a business is running out of cash, you have to do a lot more tracking, you have to do a lot more accounting, you have to do a lot more managing. That takes time and money, and so it's like, if a company is somewhat funded, they're running into cash flow crunch, and they catch it in time, they may literally be paying some of their last dollars in cash to someone like us to help them manage that flow and see if there's any way to turn it around, or at very least help them spread it out as long as they can. And and it's tragic. So the one key piece of advice I have on this is, get the advice and get the systems in place to manage and track cash flow before you get to this point, because it's far less expensive that way, right? I mean, if I'm working with clients to set up a process for managing their cash flow, and we're able to track it on a monthly basis and have a good way of seeing where it goes, that's a far less expensive in terms of time and effort than if they're already in a cash flow crunch and now we got to run schedules every week or every day to make sure they're not running out of money in the accounts that day. So that's what you don't want to get to that point, and you want to have an early warning sign before you get to that point. And so that would be my thing, is that those suggestions that are in the article are all well and fine, but I'm probably not having that discussion if they're already there, because they can't pay for us at that point.
Well, not only that though, but I think you highlighted something that's clear to me is if you're in a cash crunch, then essentially you haven't planned for cash flow planning, because you should have had some kind of idea that this was coming, or at least early warning signs, that you were headed this way. I think, and being proactive about this is your best bet. I mean, I think if you don't at least have like a monthly forecast or some kind of like idea of where the business is going, you're kind of just operating on past tense, and you're setting yourself up to be vulnerable for a downturn in sales or a tough patch. And I think, the article lays out maybe some good, like, napkin style remedies to that, having a savings or some kind of credit line that you can tap. But those are really lifelines. You can't, if your revenues are falling and your expenses are staying the same, a credit line or a cash savings amount is only going to bide you enough time. That's really a management and an accounting position that you don't want to find yourself in to try and right the ship, I guess. And so having a model ahead of time and being able to look at that and be able to predict, or at least have the warning bells go off that a situation is coming, gives you more time to react to it. And I echo Ty's sentiment. If you're in a cash crunch like that, it's almost like it's too late at that point to be able to pay for something, for you to be able to muster enough cash for somebody to give you an answer that's going to mean anything. You're going to spend your last dime on having the plan set up, but then not enough money to initiate the plan, or review it. So I think being proactive about this stuff is job number one. And I think it's something that business owners don't often think about. Smart ones do, ones that are experienced, but I think a young or a new business or an entrepreneur doesn't think about these things when things are going well. Cash coming in the front door. We always have money to pay bills. Don't even need to worry about our terms. But you don't have a plan for the future growth. And that goes the other way too. Growing. People often forget that growth takes money. If you're making widgets, you make, 10,000 or 100, you've projected that you going to make more widgets. That costs money for raw materials, labor. You're putting money out the door to get money back in. Have you planned for expansion? You can get in a cash crunch from having more demand. So I think it's, it works both ways. I think you really need to have a plan, stick to it, and work with a professional that knows what they're doing ahead of time before you get into a cash crunch, either because of expansion or contraction in your business.
Yeah, I gotta say, I agree completely. It's a problem that you have to act proactively to, and you just got to realize that your cash position is the sum total of all the decisions and agreements that you've made leading up to it. And so basically, if the things you were doing to get there didn't make sense, then until you change that issue, then you're just going to continue on down that same path. So yeah, I think good points. Do you have another article we can talk about, Jack?
Well, we didn't plan it this way, but I think this next article is a perfect complement or follow-up to the article we just discussed. This one comes from SBA.gov, and it's funny. I mean, all we hear about in the news is PPP. We've kind of beat up the PPP guidelines and regulations on this show a little bit, but guess what? The SBA is still out there with loans available to business owners for a whole multitude of things: expansion, working capital, lines of credit, equipment purchases. So there are businesses out there that have been able to manage, thrive, even grow during the COVID crisis, and there are programs available through the SBA. Now the article goes and acts like it may be a little bit more cumbersome than going through a bank. I don't know. I look at the requirements through there, and I don't think they're going to be any less cumbersome than a bank. I mean, you're probably going to go through one of the SBA preferred people, but there are a lot of different SBA programs out there where if you can take the timeline and you have the documentation, it's like anything else. It's not like they're giving money away, but if you're credit worthy and you've managed things well, there are some government programs through the SBA that you can use to expand that business, refinance things in that business, grow that business. And in the long run, they're going to be a little bit more affordable than you might get through different channels. And I think as business advisors, kind of dovetailing on that other article, it's just one of those things. I think you need to have knowledge of these things in your toolbox to where you run into these business owners and you have their challenges, and it's just another suggestion or another avenue you can offer to them.
Have you had experience with this, Jack, the 7A loan?
I have not. I know the franchise owner at the business brokerage, and that's kind of what spurred me to go look at it was, I'd gone out there and he was telling me that, going into the year, SBA was going to be waiving some fees and making some things even easier for people looking to get a loan to acquire a business. So that's kind of why I went out there. And I was kind of surprised to see that. And I think that's been updated within the last 2 weeks. So I was just kind of reading through that and reading through the different guidelines. That's kind of was my whole methodology was getting up to speed to it on myself. So I did not know about the details, did not know about a lot of those programs, and was kind of pleasantly surprised that those programs do exist to the small business owner.
I think maybe that's a lesson for the article is that, like, I think as a business owner or as somebody that's, trying to start a business is to look everywhere for your kind of, for opportunities out there. And it looks like this SBA 7A, I mean, it definitely loan benefits. Their listing is established working capital, refinancing debts, purchasing equipment, buying land, expanding existing business. So this 7A loan that you mentioned or you have an article on kind of hits it all. So and the fact that I don't think any one of our panelists here knew what this loan was kind of says, I think people need to take a deep look at what resources are out there for them. And the SBA is not just loans. I mean, you talk about business, they have business plan stuff that you can download. It's a great resource, I think, for small businesses and solopreneurs and young entrepreneurs. So I would just urge anybody in our audience to do as much research as you can in the time allotted to find out what's available for your business out there and what help is available. And this is a loan, though. I mean, you have to pay it back. It's not like the PPP where it's forgiven. But if you're going to take on a loan from a traditional lender, you might look into looking what it takes to get one from the SBA and the 7A loan and see if it's a better, run the numbers, have your accounting department run the numbers and see if it's going to be a better deal.
Yeah, I think Jack already said it, but yeah, the 7A program is designed for business expansion, and so it's used. You either use it to expand your business or to acquire new businesses or use it in acquiring businesses. And that's great to hear that they're making it even more available. This came on the radar last year because they did this last year as well. They kind of loosened up on some of the regulations related and the requirements and the fees and everything related to 7A. I think that the issue part of it is that it's for businesses that are already operating or business operators who already have experience, right? So you have to have a business that is expanding. So you already have an existing business that's expanding. If you are looking to use 7A to acquire a business, typically you have to have a resume that shows that you actually could operate that business. So, for us, for example, we potentially could use the 7A program to acquire other accounting practices. We have credentials in that area, and that would be the kind of thing that we could do with that kind of program. But it would be hard for us to use the 7A program to go out and acquire I don't know, what's a business we'd want to be in that we're not in?
Pizza.
Yeah,
ice cream.
Pizza joint.
Yeah.
I
Okay.
have
Well,
a hard
we're
time using a 7A loan for myself to acquire a pizza joint because I don't have the restaurateur or the pizza experience.
Ty, if you decide to expand, I know a good broker.
And I know somebody with pizza experience. Let me tell you, did I ever tell you I worked in pizza?
You may as well. You should be looking for those accounting consulting firms that maybe would be a good fit for us. I've assumed they just don't exist, but I would love for you to prove me wrong.
I'll die trying. AJ, what else have you got for us?
All right, our next our next article comes from Accounting Today, and then the title of this one is CPA firms. It's trying to reset your approach to PPP. So essentially, what the article is getting at is the first round of PPPs. I mean, for lack of a better word, it was kind of the Wild West. I mean, you just certified you needed the money. Urged, for accountants, I think anybody that got a call on whether or not we should take the PPP is like, do you need it? Do you think you need it? Well, I would apply because it looks like you're probably going to be able to get some of it forgiven. This round, though, when they reset the PPP loan applications round 2, they're a little more, I guess they learned from their prior mistakes. And so basically the bullet points to the article are there's a broader range of businesses and nonprofits to serve. So new eligibility for first-time applicants like Chamber of Commerce, housing cooperatives, local newspapers. So if you have any of those in your portfolio clients, you might reach out to them and see if they need your services to help apply for this PPP loan. The other thing is, like we talked about, kind of it was the Wild West in the first round. This time the rules are little bit better defined. And so there's a lot to get through. I think there's a lot of value that an accountant can add that has good experience or knowledge in this area. So I think this time around, they're requiring you to show that you actually need the money, not just certify that you think you're going to need it. So you may need a CPA or your accountant to come up with that kind of information to give to the bank or the lender that you're going to do. This time around, lenders have latitude around rules and processes. So I think before it was kind of, the first PPP was rushed and it was kind of left up to it was kind of told to the bank, you can go ahead and issue these loans and the SBA will cover you kind of thing. This time it looks like the banks are back in the driver's seat. And so if, for instance, your bank denies you, there's an opportunity to go to a different bank, I guess to have the PPP round 2 looked at, your application looked at by a different bank. So there's definitely an opportunity, I guess, for bank shopping in this one. This time there'll be greater scrutiny of applications at the time. So I think it, again, leads to you having solid numbers and solid information to provide to your banker that might necessitate you seeing your CPA or having help in putting these application round 2s together. And the last part is, I guess for all the CPA firms, they had to leave a footnote here that strategic implementation will remain after the pandemic. So they're just talking about engaging with your clients and 10-year relationships and making sure that you're being of a value to your client. But I guess I'd like to ask our panelists here, like, did they miss anything, or is there anything surprising in that list that we didn't know about? I mean, we have to get one PPP loan, article in each week for our clickbait. So I thought I'd throw it in there.
Yeah, PPP, a favorite topic of accountants nowadays. And frankly, you become everybody's friend once you know a little bit about the PPP. They come out of the woodwork. Hey, do you know how this works? How about for my business? Even people I haven't talked to in perhaps years want to ask me questions on this. A couple of the things, I'm really appreciative that we have some greater clarification, because for that first round of PPP, it was the Wild West. You had no idea what the requirements were going to be on the back end, and they were making up rules as they were giving this money out. And then the first tranche ran out and everybody panicked because, you heard the stories of this company took out 3 million and bought Lamborghinis and, all the sensational stuff. But it seems like this is a much more controlled and clear rollout this time. And with some experience, it feels a little easier to be able to tell clients the directions to go in. I've worked on a couple of these just in the past week. And, I think one of the points, they're really clear up front now that the paperwork burden for loans under 150,000 is going to be less than for those over 150,000. It's good to know that number now, because I think for the first round, it was less than 50,000 or something like that. So, they're realizing what the burden of paperwork is on the IRS and some of these other things, and having a set of rules in front of you certainly makes it easier to move forward. I also have a client who has talked about perhaps taking more than the PPP Even if he doesn't know that he'll need all of it for employment purposes, the money that he would have to pay back is only at 1% interest. I'm not saying that this is a good strategy, but I'm saying this is a strategy that people are starting to look at because information is power, and using professionals who can kind of guide you through that process and through the lovely employee retention credit, like we talked about on the last show, some of those kinds of issues that pop up make this a much easier process than we had in round one. Other thoughts?
Yeah, I just want to say I'm a big fan of the change that they made to where the multiplier of the average monthly payroll is different for different industries, so that it gets the assistance to the places that need it the most. Because as we saw, the pandemic was not an equal issue for every company. It really depended on what you were doing to determine how affected you were by it. And so I think that them just refining it in that way is better. I think them making the simplifications to the application process and to applying for forgiveness is a good thing. And yeah, I'm with you. I think a loan at 1% still sounds like a win in a lot of business owners' books, especially if there's some hope of forgiveness, based on the facts. And so yeah, I think it's wise to evaluate all options, even if you may end up with some funded debt as a result of that.
Well, I think the lesson learned is the more time you have to put something together, the better it looks. So for all our accounting friends out there that's doing year-end stuff, take your time. You might be able to be as shining as this new PPP round 2. Anyway, Mark, you got another article for us?
You bet. Last article I have is from Ars Technica, and it's about our outgoing FCC chairman, Ajit Pai, who recently declared that 3 megabytes of upload speed is still fast enough, based on a standard that was made, I think, 6 years ago. And this is what they're calling advanced internet. So they've been trying to get advanced internet out to schools and other institutions all over the place to kind of bridge the digital divide between cities and rural counties that don't have good internet. And so the US wants to make its metric look better by saying that 25 megs down and 3 megs up is considered advanced internet. And that was the standard 6 years ago. But here we are in 2021, where kids are using Zoom every day to go to classrooms, and there's a lot more broadband being used in the home with parents working, kids going to school, and 3 megs upload seems woefully shy of what I would call advanced internet. I think we did a story a few weeks back on Starlink with their better than nothing internet, and this kind of harkens back to, this is a kind of, I don't know, it's a shell game. Like, yeah, we're doing great. We can now say that 60+% of the country has advanced internet, when some of these rural areas, or some homes in particular that have really slow internet, are still struggling mightily to meet the demands. And I will freely admit I'm not a big fan of Ajit Pai, since he kind of did away with the net neutrality rules. We don't need to go down that road, but I'm curious if maybe my bias is showing through in this article.
Well, I just like to thank Ajit Pai. I think over the last 4 years, he's the one thing that's brought the America together, is the hatred of Ajit Pai and his proposals on, kind of net neutrality, and thinking that 3 megabytes upload is an acceptable internet speed. And I think the silliness of that really shines through, like you said, during the pandemic. I mean, I think if businesses are trying to operate an online business with 25 megabytes down and 3 megabytes up as being acceptable, I don't think that really works. And I think realistically, the real problem with this is the monopolization of internet providers. I think is really where this really, puts a monkey wrench in the cog of moving forward. Is, there's no reason to innovate if you're the only show in town. And I think a lot of America is locked into one provider. I mean, I'm lucky enough to live in a neighborhood and an area that has 2 providers. But I mean, I think it's the same reason the last big antitrust breakup was AT&T, because they had a monopoly over the telephone at the time, and there was no other show in town. I think The same holds true for the Comcast, the Cox cables, the whatever insert internet company here has. And I think the only way to break this is probably wireless, cellular networks, 5G being, available at quote unquote everywhere, I think is what will break the monopoly. But if you're a business or an individual trying to use internet, usually you have two options at best, but probably one in your area, and they get to name their price because you need it. And so I think, it's sad that they think that that's an acceptable rate. It's sad when you look at the rest of the world and you see places like Europe and South Korea have, 100 gigabit second available for $20 a month. I weep a little bit when I see that. My online gaming weeps. I die to lag nightly, and I blame my internet. I mean, I think anybody else would. So, good riddance, I guess, to a Jeep Pie. See you later, buddy.
Yeah, you know what they say, it's a Jeep Pie and we all got to take a bite. It's a good, the thing is that basically internet is access to information. It's a utility, it's a public utility. And if you ever needed any better kind of like argument to understand why that is, let's focus on the fact that a book, Fahrenheit 451, was written about the idea of basically controlling access to information from a population. And here we are talking about how internet should be basically controlled by the one person who has the power and is, heavily influenced by money and a lot of other players and that sort of thing. And so, yeah, I think it's time that we just sort of all take over and realize that internet and, is probably one of our most important utilities, and that we need control over it in any way possible, not by lobbying and not by a Jeep Pie.
All right, everyone. Thanks for watching the None of Our Businesses podcast and YouTube show. Be sure to like and subscribe and give us a 5-star rating on Apple Podcasts or your other pod catcher. We really appreciate you joining us to listen to some business stories from an accountant's perspective. See you next time.
See ya.
Bye.